There's the closing bell on Wall Street, and now it's market domination overtime. Jared Blikre going to be along in a moment to get you up to speed on the action from today's session. I'm going to start with the major averages and where they ended. And one thing occurs to me as I'm looking at the charts for today, and that is there was some measure of stability or a pause today. Unlike many of the charts we've been seeing over the course of the week, where you really see major gyrations intraday in the markets, both to the up and to the downside, you didn't see that as much today. And indeed, you've got the Dow closing pretty much to the highs of the session, up 674 points, about 1.75% here. So it's been an interesting move and maybe a little bit of a sigh of relief. As Myles and I talked about earlier, it doesn't mean everything is sunshine and roses from here on out. Maybe just a little bit of a break in the selling, both because it looks like there's not going to be a government shutdown and because there was no new tariff headlines for the moment. We'll see what happens over the weekend. The S&P 500 also closing at the highs of the session, up 2.1%. The NASDAQ composite leading the gains, up 2.6%. So large cap tech definitely participating, a part of those gains. But we're seeing participation elsewhere as well. The Russell 2000, which has just been battered, back today, up by about 2.2%. As I say, we'll see if it keeps going. But for now, we've got the buying happening. Jared, what else are you seeing today?
Thank you, Julie. Nice to see some buying today. And as you mentioned, too, the very steady, untroubled market, it seemed. This is Russell 2000. Many days we've been kind of gapping up here only to go lower and then end the day lower. And today we ended higher. Now, we're still looking at some losses for the week. Let's take a look at the small caps, 1.84% to the downside for the Russell. The NASDAQ down about 2.5%. And the Dow down about 3%. That's going to be the worst week for the Dow in some time, I believe since 2023. Got to check the final stats there. And want to check in on volatility because volatility has been dropping nicely since Tuesday. If we do have a peak in volatility, stocks can still go lower. Indices can still go lower even as the VIX drops, but we don't have that same momentum. And so it would be nice to think that we've had a VIX high just so we don't go down anymore with that same momentum, which would really drive prices lower. Let's take a look at the 10-year bond market, up about 3 basis points today to 4.31%. Nothing to write home about. And then we have, let's check in on the sectors today. This is a 5-day look, which is interesting. Only energy and utilities in the green. Consumer discretionary and consumer staples, the two consumer sectors, each of those down 4%. So it doesn't matter if you were looking discretionary and in a cyclical way or in staples, a more defensive way. Both of those were down. And let's take a look at the NASDAQ this week. Pretty red, especially in the mega caps, except for NVIDIA that had a nice 8% pop. And I'll leave it on what happened today. There's a nice field of green for you. And I'll send it back to you, Myles.
All right, Jared, thanks for sending us into the weekend. Good vibes there on the green screen. All right, stocks capping off a volatile week. Fears about the economy, tariff policy, and those pesky valuations weighing on markets. Joining us now to talk about this week's action and how investors can weather the storm is Rob Williams. He is the managing partner and chief investment strategist at Sage Advisory. So, Rob, you've heard us chatting a little bit about the market, maybe talking this week, what we've seen over the month of March, certainly been shaky for stocks. What have been the main drivers that you've been looking at and how you've tried to make sense of, what has ultimately been a pretty quick 10% pullback for the S&P from those records reached in mid-February?
Yeah, I mean, it's been uncertainty's been off the chart, and you try and avoid the word uncertainty, but you can because that's the reality of what we're facing. And like you said, today was okay because you didn't get any more bad news. But the big picture for the last month has been the markets had to grapple with the level of uncertainty adds to the downside for the economy, right? It definitely hurts the optimism sentiment, the soft data. Anything that's survey-based has been killed over the last month or so, right? You've gotten plenty of evidence. The service sector, PMI, small business optimism. Today, you had consumer sentiment that was as low as it's been in about 2 years. So this is feeding the fuel, the overall view that, hey, the growth downside risks have gotten bigger. This could bleed through to the hard data. Things like retail sales was weak last month. Consumer maybe was already getting a little shaky, and this is going to feed into that. And then you throw on the fact that the government is trying to cut spending and jobs, and that's certainly going to bleed into the job numbers, and we haven't even seen that yet. The government sector has accounted for about a third of payroll growth over the last 2 years. So you start taking that out. So I think people are grappling with inflation, as you said, but they're worried about both growth and inflation.
Rob, at what point does the sentiment get so bad that you want to get in? I mean, for example, I've been watching the AII surveys, the American Association of Individual Investors, newsletter writers, folks who kind of have their finger on the pulse of market sentiment. And we're seeing that bearish sentiment, the white line there, really at extended levels as the bullish sentiment goes down. At what point does that become a signal to maybe step in?
Yeah, it could certainly give you a bounce, and that's probably what you're going to get over the next couple of weeks. Who knows what the catalyst could be to that, but you're exactly right. I've seen two indicators. The RSI for the S&P obviously got into oversold territory. We broached that 10% correction, and then the bullish bearish, we've gotten very bearish quickly. So you get a little bounce for sure, but I'm more worried about the medium term, right? And this idea that we've gone from worrying that growth was going to be so strong that the Fed was not going to be able to cut, they might hike. And now we've pivoted to growth is going to be a lot weaker. Cuts are back on the table. And then now we throw in the fact that we might get a little stalling of the deflation trend on top of that. So short-term bounce, medium term, I still like anything that has a higher yield in the portfolio, right? Even with the re-rating of stocks, I think bonds remain very attractive. 5-6% safe yield in bonds is a safer route than thinking about adding to equities with valuations still where they're at.
You know, Rob, we had Brian Belsky at BMO on earlier in today's programming day, and he was talking about getting even more constructive given how bearish sentiment has gotten over the last couple of weeks. It sounds to me like perhaps you're still not fully sold, that we haven't seen the bottom here in markets, or however you want to say it. It feels like sentiment might have a little more to go in terms of washing out some of those animal spirits. But I am curious, as you look forward, if there are specific sectors or names or things you might be pointing to as signals that there's been a change, if we agree that there was a material change in how folks thought about it come, let's say early February, what you're looking for out the next couple quarters.
Yeah, I mean, like I said, we haven't even seen the implications of the job market fully, right? I mean, data's been hanging in there, but, February, the layoff data was up 100%. I mean, it was triple what we've seen. So it's coming. So we're going to see a little weakness, and we're going to see how the market's going to digest that. There's always opportunities. I think you can gravitate towards yield generating areas of the market for sure. We knew we were priced to perfection going into the year, right? 23 PE, where we were going into the year, was priced very high. So we were probably going to have to re-rate at some point. And that's okay. And I think that's healthy. I think on the equity side, where you look for opportunities is just over the medium term, I need to have more diversification, less concentration. And guess what? You have to pay attention to valuations right now. And we thought going into the year that meant have more international in the portfolio, be spread out a little bit. Even though the small caps haven't done great because it's been a risk off, I still think small caps are a good area to be looking in right now because it removes some of that concentration risk that you've been facing, and the valuations are still more attractive. And then everyone's been growth, but I think you start thinking more about value. You've talked about the banks earlier. I think some of the value sectors are the policy winners. They're more attractive valuation, and they've got good fundamentals, things like banks, energy, utilities. I think those are the opportunities to be thinking about on the equity side.
Rob, thanks a lot. Good to see you.
Good to see you. Thank you.
President Trump's tariff strategy turning out to be far more disruptive and damaging than almost anybody guessed when he took office just a few weeks ago. So is anyone still supportive of it? Joining us now, Yahoo Finance's Rick Newman. I think it's safe to say there are still, I don't know.
I think Trump supports it.
Yeah, people, Scott Bessent, Howard Lutnick, Peter Navarro, there are people who support it.
Have we had anybody on air this week who said, yeah, I'm down with this? Maybe we have, maybe I missed it. I mean, the Wall Street Journal had a fun story this week. They found a few Trump supporters who have been losing money in their retirement plans, and they asked them what they think. And they sort of got responses like, well, I would prefer it weren't going down, but maybe something good will come of this. Look, I mean, this is all gone way further than anybody expected, I think it's fair to say. And it's really starting to show up in real impacts in the economy and the way people feel. So what do we get? Consumer sentiment today for Michigan, the lowest since November of 2022. November 22, but just to remind people, that was sort of at maximum inflation shock of the Biden administration. And that's how the same people feel the same way now. We're seeing growth forecast cuts all across the economic forecasting landscape. Goldman Sachs, Morgan Stanley. We're seeing cuts in estimates for where the S&P 500 is going to end up by the end of this year. Everybody's cutting every forecast. Everybody's confidence is collapsing. And Trump's reaction has maybe been the biggest surprise of all. His reaction is, I'm not going to stop. So we're getting more tariffs soon, according to him. And we don't know what Trump's pain threshold is here. I think we have blown through assumptions that he would have stopped by now when he saw market correction. I think we thought when he came in that would do it, but it hasn't. So more is coming, I guess, is the story from the White House.
And, Rick, we're not quite through the first 100 days of the second Trump administration yet, but it feels like the whole seriously, not literally meme, which kind of dominated the first time around, folks are still not really ready to give that up. But so much of what you're talking about just seems like, all right, I mean, he said he's going to do this. He says he doesn't care about stocks. He says he wants more tariffs. At a certain point, that's it. That's the story. And do you see scope for Trump to act more like he did, 6 years ago? Or is this just a different president this time around?
Trump is not acting the way he did 6 years ago. That has been the shock. And you could also almost flip it around, take him seriously, but not literally. You could almost at this point say, take him seriously, take him literally, and assume it will be even worse than what he says, because that is what we've gotten with tariffs. And this is all tariffs. I mean, when it's hard to overstate how astonishing it is that a new president, and I love that you just used the first 100 days formulation. New presidents usually use those first 100 days to do things that make them more popular, giveaways to the people. I mean, Biden, he passed more stimmies and all kinds of other giveaways in the one big stimulus act he had. And Trump is coming. I mean, I think this is literally unprecedented that a president comes in and says, I'm going to reorganize the economy. We're going to have this detox period, as Scott Bessent, the Treasury Secretary, did. And it's going to suck for you guys for a while. The question is it ever going to get better? And I think now we're starting to see cracks in that. I mean, almost every economist will tell you Trump's tariff plan is not going to accomplish what he says. We're not going to have more growth in the future than we would have otherwise, because he's making imports and a lot of other products more expensive. That's going to generate less growth. That's why we're seeing these cuts in the growth forecast from all the forecasting firms. Maybe some relief is coming at some point. But I think we're just getting a lot of gloom because there is no relief.
Well, we'll check back in with you, Rick. Thank you.
Probably going to be even worse.
On that optimistic note.
It's worse every day.
Have a great weekend, Rick.
Oh.
All
Bye,
right.
guys.
Thank you. Coming up, we're going to break down all the pending antitrust cases that the U.S. government has against big tech. More market domination overtime coming up.
All right, well, President Trump's antitrust enforcers are not backing down from legal fights with big tech. Joining us now for more on this is Yahoo Finance's senior legal reporter, Alexis Keenan. So, Alexis, when Trump was elected back in November, there was not only a big sigh of relief from big tech, but It was like, let's even cozy up. This might even be better than we think. And
a lot of cozying up.
Now we're getting into the process, and it doesn't really feel like the inauguration feels like a very long time ago now.
I'll give you that. Yeah, so we've been trying to kind of come up with some sort of crystallized version of what is the new Trump era, Trump 2.0 antitrust policy, particularly for big tech. Trump is actually giving a talk right now at the Justice Department. He hasn't talked about big tech yet. He's still going, so there's still time for that to happen. But what we've been seeing is really this aggressive posture towards big tech, right? Because you have Trump picking up where his original administration left off, picking up where the Biden administration's enforcers left off with a bunch of cases. You've got 2 cases pending against Google, one that's going to go into the remedies phase starting at the end of April. You have a trial that's about to start against Meta. You have Apple with a pending case, not yet set for trial. You have Amazon in online retail being prosecuted by the FTC. And you also have the FTC looking at Microsoft and broadening its probe into the company, its relationships, even with OpenAI. On top of all that, you have FCC Chair Brandon Carr wanting to limit the liability protections that these big companies have, the social media companies, particularly around Section 230. You also have the FTC Chair Andrew Ferguson saying that he wants to keep the Biden-era merger guidelines. So you have a lot of aggressiveness, but where we're seeing a carve-out is with respect to AI regulation and enforcement. That's the part where just this past week, the Justice Department decided to withdraw a requirement that the Biden administration wanted in the Google case. They wanted Google to be forced by a judge to divest its AI investments. And the Trump DOJ is saying, no, we're not going to do that. And that's kind of in line with what we've been seeing, right? Because on day 1 of Trump's administration, he signed an executive order that revoked Biden's rules for AI, wanting there to be more safety and protections around it. We also saw last month J.D. Vance, the vice president at the Paris AI Summit, saying that we're not here for AI safety, we're here for AI opportunity. That's what we want to talk about as a U.S. Also, you had the withdrawal of that search element in the remedies portion on those AI investments. So that was a big one. And so it's starting to reveal this policy that is kind of AI light, let's say, more of a lighter touch than Biden would have expressed. So also, this idea has some support from Congress. In December, there was a joint task force on AI from the House, and they expressed concern that China was moving ahead, that they had more patents than the U.S. did on AI, and that they really were concerned from a military DoD perspective, wanting to make sure that the U.S. kind of moves fast and break things.
Well, we'll see if they can achieve both, right?
Yeah,
Have the U.S. move fast and break things while at the same time coming down on some of these large tech companies. We'll see what happens. Thanks, Alexis. Appreciate it. Well, Apple's top executive overseeing its Siri virtual assistant told staff this week that delays to key features have been ugly and embarrassing, or at least the explanation of them has been the rollout, with a decision to publicly promote the tech before it was ready, making matters even worse. This all according to a new report from Bloomberg. The comments show just how badly Apple is struggling to catch up on the field of AI. Joining us now, Tom Forte, Maxim Group Managing Director and Senior Consumer Internet Analyst. Tom, it is great to see you. I find this narrative around Apple really fascinating because when it comes to AI, is there any consumer electronics company that is doing it, right? That has come out with all of these products that are courting this for consumers? How are you thinking about how Apple's doing?
Yeah, so when I think about the rollout of AI features for Apple, I start with the disconnect between the timing of the hardware and the software. The iPhone 16 was available starting in September last year, and then iOS, or different flavors of iOS that started adding the AI features, started rolling out in October, and they're still not, globally available. They're definitely not available in China. I don't know that anyone is doing well other than OpenAI, if you want to consider Gemini good, or Google. As a longtime follower of the industry, I've been blown away at Amazon and Apple's inability to convert on early positions with Alexa and Siri. They were so early on essentially AI-powered assistants and have failed to convert on those opportunities. So yeah, I don't know that anyone's doing well, Julie.
And Tom, I guess when we look at the Apple story and really the raft of commentary in the last week, it feels like, around their AI product roadmap and where those features are at, I feel like there's maybe a read-through or a connection that some folks aren't making, that the question is like, is this still the same Apple? We still, the Vision Pro came out and it was cool, but we don't really talk about that anymore. And now everyone talks about AI and the company's pushing out its timelines. And I'm sitting on a Mac computer. I love my iPhone. I'll go get another one. But what is next for Apple? It feels like remains kind of an open question here. Yeah.
So if I told you it's foldable phones, we may all laugh. But the future of Apple may be, different form factors for the smartphone, things of that nature. Really, what's driven the stock over the last couple of years is the advancement of the higher margin services business. So in that regard, I'd say they're still doing quite well. Either it's Apple Pay, they just added Apple TV Plus to Android devices. They have a very large installed base. So I would say services, they're doing quite well. On their hardware front, they haven't found the replacement. You mentioned Vision Pro long-term for the smartphone, but the good news is they haven't had to. So the smartphone has proven to be much more durable and the product cycle much longer than I think anyone anticipated. And I think Apple might be okay in that regard.
So, Tom, something we haven't talked about that's obviously a big deal also is the whole tariff question, right, in this sort of macro environment. How are you thinking through that and the implications for Apple?
So the big challenge for big tech is to what extent are we already in a global trade war, or what extent are we potentially entering a global trade war? And as it pertains to Apple specifically, their overdependence on China. So they still are highly dependent on China from a manufacturing and assembly standpoint. And then they get a high teens % of sales from China. So to the extent that you see consumers outside the US opting to purchase from their local provider, not from Apple, in this case, say Huawei, that's a huge problem for Apple. And it already was a problem. When you look at the December quarter, their sales to Chinese consumers were down more than 10%. So I do understand why the market is anxious about tariffs as it pertains to Apple, as it pertains to a potential trade war with China.
And then I guess, Tom, finally, looking at the broader tech setup, and you mentioned some of Apple's peers, especially Amazon when it came to voice, and just thinking about where those names are, these consumer names in the AI cycle. I don't know how you maybe stack rank them or what you've made of what we've seen in the markets recently, but there's just kind of a mess here going on where we're talking Apple product development. We're talking about this company falling behind on that. Is this valuation too high? Like, as you've tried to talk through these names with clients, where are you netting out on this story, as we sit here March 2025, 2 years really into the AI boom?
I'm still leaning on Amazon because if you compare Amazon and Apple and Meta and Alphabet, they have a very large blue-collar workforce. So to the extent that they're able to use artificial intelligence to have more automation at the fulfillment center level, this could mean more to Amazon from both a revenue standpoint at the cloud computing level and at an expense standpoint with greater automation at fulfillment center. Apple's essentially using others, think Foxconn, for their large blue-collar workforce. So they don't stand to benefit in the same way from lower expenses from AI. So I think in that regard, Amazon's kind of unique to really capitalize on AI and still my favorite among the mega caps.
Tom, interesting as always to talk to you. Good to see you.
Thank you, Julie. You too.
Thanks. Time now for what to watch next week. Starting off on the Fed, March's two-day FOMC meeting is going to be kicking off on Tuesday. Wall Street largely anticipating the Fed will hold interest rates steady, and we'll get an updated dot plot on Wednesday as well, when Chair Jerome Powell will also be holding a news conference. Although the latest consumer price index report showed a little bit of cooling, inflation does remain stickier than the Fed would like before it resumes rate cuts.
And taking a look at earnings, we'll get another batch of reports. Still looking at the consumer. We've got General Mills, Nike, FedEx, among others. Nike will announce results for its third quarter on Thursday after the close. Analysts expecting a weaker quarter for the company as it faces pressure from markdowns to clear out unwanted inventory. This also marks the first full quarter of the company for recently appointed Nike CEO Elliott Hill.
And finally, we're gearing up for the 2025 NVIDIA GTC Technology Conference next week, or it's the GPU Technology Conference, also known as GTC. Industry leaders are coming together to talk about the future of tech, from AI to quantum computing. Yahoo Finance will be bringing you special coverage of that event, including CEO Jensen Huang's keynote address Tuesday at 1 p.m. Eastern.
All right, and that'll do it for today's Market Domination Overtime. Be sure to come back on Monday at 3 p.m. Eastern for all your coverage leading up to and after the closing bell.
Well, don't go anywhere. On the other side of the break, it is Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market moving stories so you can get ahead of the themes affecting your money.